Taxes don't stop in retirement. In fact, they can get more confusing. Today, we're breaking down what you need to know to keep more of the money you've worked so hard to save. We'll cover pre-tax, after-tax, and taxable accounts, how federal and state income taxes differ, plus how laws like the One Big Beautiful Bill Act and Secure Act can impact your retirement. Hi, I'm Molly Nelson here with Lauren Merkel and Sean Honkamp, and let's get right into it, guys, because before people can make better tax decisions, they have to understand how accounts are taxed. So first, Sean, let's talk about pre-tax accounts. What do people need to know?
It can be really helpful and really valuable to have that knowledge about the tax diversification. When it comes to the pre-tax accounts, for most of you, that's where most of your retirement savings is often located. Those types of accounts have been around longer. So when you think about the pre-tax, it's your traditional 401k balances, it's your traditional IRAs. Those have been around longer. You've been saving into those accounts longer, which is why most of you have a majority of your retirement funds in those pre-tax accounts. With those pre-tax accounts, when distributions and those dollars are coming out of those accounts in the future, those are all going to be taxed just like ordinary income, just like when people are receiving their paychecks today.
Yeah, and that money went in tax deferred, which was a bit of an advantage on the way in, but on the way out, sometimes paying taxes at ordinary income rates can be a bit of a disadvantage.
A disadvantage and a surprise a lot of times. You have $1 million saved for retirement. You're thinking, I did a good job. I saved $1 million over the course of your career, and now I can use that for retirement. But if it's never been taxed before, when it comes out, it will be taxed. So you don't really have $1 million that you can spend. For many people, it's going to be closer to $750,000, maybe $800,000. I mean, we look at the retirement tax bill that most $1 million account savers have over the course of a 25-year retirement, it's over $500,000 over the course of that time frame. So now it's a matter of how do we mitigate that as much as possible to put more spendable income into your pocket.
And somebody at home watching might be thinking about their own traditional IRA and thinking, well, that was money I was planning on passing on to their children or a niece or nephew or a charity. I'm not going to worry about the tax impact. Well, guess what? RMDs kick in, and you will have to worry about the tax impact. So be forced to take that money out at some point.
You might want to have certain decisions that people want to make and that you think you have full control of, but with the laws and regulations and things that you have to take, sometimes some of these decisions are going to get made for you. So you've got this pre-tax balance saved up, and then now when people hit 73 or a few years down the road, it's going to be going to 75. Now people have to start taking a certain percentage of those pre-tax dollars out, which, like we talked about, get taxed. So now you're going to owe some of that tax bill, even though it might not be the decision people want to make. It's something that we have to follow.
Okay, anything else we need to talk about with pre-tax accounts?
That's good.
Okay, let's move to after-tax account. What are these and how are they taxed?
And there's multiple different types of after-tax accounts. There's our favorite after-tax account, which is the Roth IRA or Roth 401k plan. The way that works is you put your money in, it's already been taxed. That's why we call it after-tax. And then it grows tax-free. So later down the road, a qualified distribution comes out completely federally and in most cases state tax-free. So if you have $1 million in your Roth 401k plan, when you take it out, you actually get to spend $1 million of that account. Very powerful, and for most people, that is their most powerful retirement account if you have it. Now, if you're sitting there and saying, yeah, that Roth 401, that Roth IRA sounds like a great deal, I just don't have one of those, it doesn't mean it's too late. Many people that we work with at point of retirement or at least a couple years prior to retirement do not have those. But we can work into the tax strategies and pay taxes intentionally on the pre-tax accounts and convert that over to Roths for further use down the road in retirement. But we have to do that very intentionally and very strategically.
And Lauren, it's fun to emphasize. It really is. We need to emphasize that not too late. I mean, there's so many times that people are coming in and you're thinking you're at a certain age, you've already made up that mind that it's too late to build that Roth balance. And as long as we have a long-term tax plan, as long as we've got opportunities to move money to Roth at what we deem our favorable rates, it's never too late. You can build up that balance, give you more options later in life, and then those Roth balances can be a meaningful part of a legacy plan in the future. So don't go convincing yourself or telling yourself that it's too late to build up that Roth balance.
Another thing that's worth noting about the Roth IRAs is they are not subject to RMDs, so you're not going to be forced to take that money out at a certain time. That gives you a lot more flexibility.
And control, which is really what people are seeking as they go to and through retirement. You have done a lot of work to save this money. You want the maximum amount of control over this money that you can. The Roth IRA does that for you, not only in the form of decreasing your tax risk, because the one thing that none of us can control is what the IRS does with these tax rates, these tax brackets. And if they go up, any of the money underneath your Roth is insulated from that increase on the tax rates. Any of the money underneath your pre-tax accounts is going to feel the effects of the increased rate. So it gives you control from an RMD standpoint. You're not mandated to take it out at any particular age. Also gives you control from a tax rate standpoint, insulating you from that risk.
Let's talk about some other types of accounts. I'm thinking brokerage accounts, bank accounts, investment accounts that aren't in your retirement plan. What should we know about those?
Yeah, some of those accounts are also these after-tax accounts, but they're a little different than the Roth IRA. So we often refer to these accounts as non-qualified. That's not an everyday term, but if you think about it, any money that you have in your employer accounts or in IRAs, those dollars are considered qualified. Any dollars that are in other accounts, so think about everybody's got bank accounts. Those are considered non-qualified accounts. So you can have your bank accounts if you do CDs, anything like that. Otherwise, a lot of people, when you have enough money in your bank accounts, then you're going to take that extra money and you want to invest it. So if you open a brokerage account at a custodian, that is considered a non-qualified account. So how those dollars work is when you put the money in, that's your cost basis. You don't ever get taxed on those dollars. As those non-qualified accounts grow, and when you take distributions in the future, you only get taxed on the growth of those. So for example, you put $10,000 into a brokerage account, it grows to be $20,000. You take the entire $20,000 out, you're only getting taxed on the $10,000 of growth. And then also, those get taxed a little differently. The pre-tax accounts are taxed at ordinary income when you take distributions. When we're taking money out of these non-qualified accounts, they can be taxed as capital gains as long as we've held them for at least 1 year. Now those are more favorable tax rates. So we like to have that tax diversification. We don't get taxed on all the dollars, and we potentially can get taxed at lower tax rates on those dollars.
Yeah, and there's a range there, right? It's 0, 15, or 20%, is that right?
Yes, that's correct. And that's why we would deem these accounts tax preferred. So the pre-tax I'm sorry, did I say preferred? That's what I meant to say, yeah.
Yeah,
so
you did.
The pre-tax accounts are tax.
No taxes are preferred, by the way. I do want to note that for the viewer. There's no taxes preferred, but these are a little bit better than ordinary
But
income.
very necessary
Yeah, that's
taxes
right.
are. So we have tax deferred, that's the pre-tax, tax preferred, which is what Sean was just talking about there, and then tax free, which would be the Roth accounts.
Those are the preferred gold standard.
That's right, that is the gold standard.
Okay, so we've talked about the different kinds of accounts and how they're taxed, but now you probably want to know, what does that mean for me? How do I apply it to my retirement? That's what we're going to get to next. Welcome back to Retiring Today. I'm Molly Nelson here with Sean Honkamp and Lauren Merkel. They're both certified financial planners. They're both certified financial fiduciaries. And Sean is a CPA. Okay, so we told them how the accounts were taxed. And really, the CPA was shining there, as they should, right? You don't file taxes, but you did for the first part of your career. And obviously, you've read all that tax law, right?
Multiple times.
Yeah, you got it by your bed. Just this morning, you went through the thousands and thousands of pages. Okay, so you gave us the nuts and bolts of that, and it was really well done. But now, Lauren, I turn to you because somebody at home is going, why should I care? And you know, because you sit down with families all the time and you try to help them understand why they should care how the money that they saved is taxed.
One of the big differences of your working career versus retirement is when you're working, you still have the ability to make money. Money's coming in. You feel confident because that money's continuing to come in. But that confidence turns to anxiety in retirement because now the W-2 wages go away and now you have this pot of money that you've worked very hard to save that has to last you for the rest of your life and accomplish all of your retirement dreams. That becomes problematic for many people because taxes take a big bite out of whatever pot of that money is, or taxes certainly can. It's, in fact, the number one wealth eroding factor when we come to retirement planning and income is taxation. So there's a lot to be concerned about. There's a lot of moving parts. Things are changing all the time. And the less money that you pay in taxes over the course of your retirement means the more money in your pocket that you get to spend towards your retirement dreams. That ultimately is why people should care.
And when you read articles online, what you just said there can boil down to a term that I read in a lot of these financial articles, which is withdrawal strategy. Now, when you sit down with families, that's not exactly how you work it out with people. You really work it out as, okay, we want to make the most of the money. We want to squeeze every dollar of it out, paying the taxes that you owe, following all the government's rules. And what that comes down to a lot of times is a very strategic plan, and one where you bring in tax diversification. That might be new to people. They're familiar with income diversification, Sean, but let's talk a little about tax diversification and how you apply that to the families and individuals that you sit down with.
Yeah, one of the ultimate goals is to have this tax diversification within your entire retirement portfolio so that you've got different dollars that are in a different tax type, which ultimately leads to control. Part of what we help the families we work with do is to build that income plan so the paychecks go away. Everybody's got a certain lifestyle that they want to live that requires a certain amount of cash flow. Let's say you didn't have any tax diversification. Everything is pre-tax, which is not uncommon. Every dollar that you need for your lifestyle is going to be coming out of that pre-tax bucket. It's all taxed at ordinary income. Now, let's say instead you had started having that retirement plan 10 years before retirement. Now you've had that time frame to build some of that Roth bucket. Let's build some of those non-qualified accounts. And now you're at that stage of life where you need that income planning, taking distributions. Now, someone like us can help you be very intentional about taking a certain amount of the lifestyle need from that pre-tax bucket. We can utilize the Roth when it makes sense from a standpoint, and we can utilize those non-qualified funds when it makes sense. So you want to have that tax diversification. It gives you more control as you get into retirement, taking distributions, building that income plan so that you can live your lifestyle and be as efficient as possible with that total portfolio.
So you're saying if I don't have tax diversification, I can get it. And I know you said in the first segment, it's never too late, but it is one of those things where the sooner you start, it is better though. There's more you can do, the 10 years before retirement than the year before retirement.
This may not be a surprise, but time is your biggest friend when it comes to any type of planning. Certainly when we're talking about something so important as your retirement, something you've been dreaming about for a long time and is going to determine the quality of your life for the next 20 to 30 years. So the more planning you put into place, the more time you give yourself to put the planning into place, the more confident you're going to feel, because the strategies that you put in place are going to be strategies you have vetted or your team has vetted to make sure that they're going to be the best strategies for you.
Yeah, so you can put tax diversification into place. That helps people get more out of their money. That's that withdrawal strategy that they're probably reading about online. Let's go back to the different types of taxes, because there's another one I know that's important to hit today, and it's kind of Social Security taxes, because I think this surprises people, the formula that's used for their taxation of their Social Security.
Yeah,
CPA, you take it away. I'm going to stop talking.
I feel like this is where she wants to talk about provisional income.
Well,
Is that what you're trying to talk about? Yes.
Thank you, CPA.
What a great phrase. So to this point, we've been talking about the taxation on these balances that everybody owns. Well, now one of your retirement assets or benefits is going to be the Social Security. So you don't own a balance with Social Security, but it's that monthly pension that everybody's going to get. So Social Security is taxed in yet its own specific way. So there's this really cool provisional income calculation. Yeah, I think everybody thinks
really
it's cool,
cool,
right?
Yeah.
So there's this provisional income calculation that helps determine how much of any one person's Social Security is considered gross income and then subject to taxation. So we talk so much about doing all these things and implementing these strategies that is meant to give you more control of your overall plan and what your tax bill is. How much of a person's Social Security is subject to tax is driven by how much other income you have in a given year that is also taxable. So again, if all your retirement's in a pre-tax account, you need to take a certain amount out. All of that's going to be taxable. That's going to drive more of your Social Security to be taxable. So if someone has this tax diversification, you can potentially position yourself to have a lower tax bill on your Social Security, which achieves that goal we talked about before, about being as efficient as possible with everything that somebody has as part of their retirement plan.
Yeah, it really could mean that you're either going to pay tax, federal tax on your Social Security, or maybe you're not, or certainly maybe you can lessen the tax, the federal tax on your Social Security. If you take advantage of the tax diversification strategies, first of all, you create that diversification, and then you also have an effective income and tax plan that works together, because not everybody's Social Security income is taxed, and it's all based on that provisional income equation.
Okay, so I did mention off the top that taxes can be confusing in general, but leading into retirement, not only do you have to think about federal taxes, but I think there are some important nuances at the state level on retirement income because everybody does it just a little bit different state by state.
It's a little bit different. Some states you do not pay taxes on retirement income. Some states you do pay taxes. Some states, after a certain threshold of income, you're not going to pay taxes or you'll pay a lesser amount of tax. The good news is in the state of Iowa, just a couple of years ago, they changed this state retirement income tax law where at the age of 55 plus, you are not taxed in the state of Iowa on any retirement income. So Social Security was already not subject to Iowa state tax, but now your distributions, your withdrawals, your income from your pre-tax IRAs and 401k plans that we were talking about before is also not going to be taxed at the Iowa state level. Other certain retirement income, like pension income, is going to be tax exempt in the state of Iowa. So this really creates an advantage for many retirees in Iowa today because the Iowa state tax used to be pretty significant to the excess of over 8.5% is what those thresholds got up to. So that could be 5, 6, 7, 8% savings to many Iowa retirees today.
Have you been hearing about the One Big Beautiful Bill Act? What about Secure Act 1.0 and 2.0? We'll talk about what you need to know next. Welcome back to Retiring Today. I'm Molly Nelson here with Lauren Merkel and Sean Honkoff, and we're talking all about taxes and retirement. And we can't talk about taxes without talking about Washington, because guess who sets the tax laws?
Not us.
Not us.
It's definitely not us.
It is the folks in Washington. So I know that that's something that you guys both watched closely. A lot of these things are changing. And when I think to recent changes, I think about RMDs. That's been a moving target in recent years, Sean.
Yeah, RMDs or the required minimum distributions, which apply to any of those pre-tax balances out there, they've gone through some changes. You go back a few years, it was age 70 and a half. So the year in which you hit a weird age of 70 and a half, yeah, you've got to fulfill those RMD requirements. Then it moved out to 72. Currently it's 73. And for some of you, it's going to be age 75 before RMDs apply to you. So we need to have that information. You need to be planning for that and thinking ahead of that because there's going to be a year where they're going to look at your total pre-tax savings and they are going to tell you you have to take a certain amount out no matter what, whether you want it or not. So have those plans in place. Know those years and the RMDs and when they're going to apply to you. If you're an individual, if it's a couple, you both are going to have, those years where you have RMDs for the first times, and have a good understanding of what kind of dollar amount we're looking at and how it's going to impact your tax bill in those years once the RMDs start. And then when they start, they continue every year going forward.
They don't go away. But if you're 55 and you're sitting at home, you're like, Sean, that's 20 years away. Well, that gives you 20 years to do some things to possibly lower those RMDs. Because here's what I do know. Here's what I've learned from you guys. The higher the RMDs, generally the higher the tax bill. So if you can lower your RMDs starting at 55, that's a good thing.
That's a great thing because, again, it gives you more control over your money, which is one of the big things that you're looking for. And that control can lead to paying less taxes. So those are two beautiful elements that can come from creating your plan and using the time that you do have on your side.
He said beautiful. Did you hear that? I think
those are wins.
He teed us up. He put that the ball on the tee and teed me up because the One Big Beautiful Bill Act, that has some big changes to taxes. Specifically, that's today's episode. And there's some things, especially for those getting close to retirement, that they need to know.
Well, and the one thing we can all agree on is the bill was big.
Yeah.
Up to about 900 pages of tax
Sounds
legislation.
like great reading for you guys.
To-do list.
Yeah.
So it definitely was big, and the implications are vast. One of the elements in the bill was the senior bonus deduction, which means that for those who are age 65 and older, you have $6,000 of extra deduction per individual. So for a married couple who meets that qualification, that criteria, that's $12,000 of income that otherwise would be taxed. That's not going to be taxed. So that can be a powerful part of your strategy, but be careful because there are income restrictions tied to that. So not everybody is going to be able to take advantage of that. Again, if you're a married couple, if your income is below 150,000, you get the full 12,000. But it starts to phase out between 150,000 and 250,000. Your income's in excess of 250, then you don't get any of that 12,000 senior bonus deduction. There's a lot of strategies that can come into this. Many of our families had have been engaging in Roth conversions over the last number of years to do exactly what we've been talking about through this show, take more control, decrease the overall retirement tax bill. However, that does mean some of them are going to need to suspend those conversion strategies until the end of 2028, when that senior bonus deduction is no longer available, because they want to take advantage of that extra $12,000 of income that's not subject to tax. Now, not everybody's going to. It's going to be dependent upon your particular strategy, but it's definitely worth considering to make sure that you are making the right decision for you and creating the right plan based on the legislation that does come and go.
And I think anytime the laws change in Washington, people read the headlines, it's really hard to understand how it impacts you. So sitting down with someone, putting pencil to paper to try to really see how it impacts you, that's the most valuable thing.
Well, and we even threw all the mess, because in that 900 pages, not all of that is going to have a direct implication to you and your plan. So let's get rid of all the noise that's not going to directly impact you. Let's focus on the elements of the bill that will focus on you. Here's how you take advantage of it. Here's how you avoid some of the traps. That is really meaningful, and you can do that within a relatively quick period of time. And it could be the Retire Ready call. It could be sitting down one-on-one for 60 minutes, but it could be creating the entire plan to make sure that all of not only the big, beautiful bill, but the Secure Act 1.0, Secure Act 2.0, and any other tax legislation is appropriately accounted for within the overall plan.
And Sean, it's surprising in these Retire Ready calls, 15 to 20 minutes, you've been able to give people real action steps. And I'm thinking about taxes and tax brackets. And you had a conversation with someone not too long ago about a bonus, whether to take a bonus or not, and taxes.
Yeah, we love doing these Retire Ready calls, whether it's to help somebody out that's just facing an immediate decision, or whether that's just the first touch point we have, and then we're able to talk further and ultimately help them out as much as possible. But yeah, just a few months ago, I had an individual call in, and he was facing a decision. He just needed somebody to help him through a few minutes. And what he was doing, he got his annual salary, and he made somewhere around $100,000. And he was getting offered this bonus, but his mind went to thinking that maybe he should not take the bonus. His understanding was that additional bonus, that income, was going to stack on top of his regular salary and take him into a new tax bracket. What he thought was then that pulled all of his taxable income, or all of his gross income, into that next tax bracket. So going back to all these IRS changes, I mean, people at home might get a sense that maybe the IRS doesn't necessarily make things all that straightforward. And it might be a little confusing understanding all these tax rules. So we were in a 5, 10, 15-minute conversation. We were able to have a good conversation. He shared that information. I got a good understanding of where he was from a household income standpoint, what the bonus was that he was facing. And ultimately, we were able to get to that point of, no, you definitely want to take that bonus. He was looking to retire in the same year. He doesn't want to wait and maybe defer that to a future year. He wants to get that bonus, be in retirement. And then he had a good understanding of what the tax implications exactly were with that bonus. And we hung up that call, and he knew, all right, I've got that decision made, and he could forget about that and eliminate that stress that he had with that decision.
I love that, because within a really short period of time, you were able to help him with an important decision that he could act on almost immediately. And the implications to him, the benefit to him, where he could then choose to retire, which is what he wanted to do, take the $20,000 bonus, which is also a really nice benefit that he was happy to receive. And he knew that he was doing it for the right decision for him. He knew why he was doing it. He knew it was the right decision. And so when he talked to his employer and told them about his decisions, he felt really good about it, as opposed to making the decisions and wondering, or delaying retirement, which he didn't want to do, and delaying receipt of the bonus, which he didn't want to do. All of it fell together, and it came from a very short conversation.
And the reason why he knew it was the right decision is because that bonus was going to be more income for him. But what it meant, it wasn't going to take all of his gross income up into that next bracket, just potentially a portion of his total income.
And that is the kind of stuff that you could learn in a Retire Ready call. Schedule yours now by going to retirereadycall.com. It's pretty easy. If you're 55 and older and you've got a question, or maybe you just want to start a conversation about retirement, this is a great place to start. This is Retiring Today, and we thank you for watching.
Thanks for watching. If you liked this video, click here for more great content from our team. Don't forget to subscribe to continue to receive helpful information for your retirement planning.